reform package, and now that it's out of committee, or now that it's been voted to go, so they can now write the actual bill, they have the outline set. What do we look for here? Well, without getting into details, the charts will be telling us one of two things: that the companies involved were the hardest, perceived to be the hardest hit, like Goldman Sachs, JP Morgan, Morgan Stanley, Bank of America, and Citigroup. I think the reaction tomorrow and the next day will tell us whether or not the profit, the bill will retard profits from a company like Goldman Sachs in its derivatives trading, which is very profitable, as well as in its proprietary trading, which has been enormously profitable. Right now, this is what you see on the screen is a year and a half Goldman Sachs chart, and Goldman built a pretty substantial top under 153 down to 147, and then it broke down, and it broke down in mid-May and has been declining since, although it does look like after it hit 131, and that was what, June 10th, that for the last 2 weeks or so it's trying to build a base. Notice the red moving average, though, is declining very sharply at a very sharp angle. It's at 144 with Friday's close at 138.25, and the last resistance plateau was 145, 146 and a half. So Goldman, in order to get any traction on the upside, really has to get through the average, close above it at 144, take out the prior highs at 146 and a half or so, and then get into the area where you have the maximum resistance, 147, 148 into the 152 and a half area. So Goldman has its work cut out for it. It has short-term positive oscillator conditions, but we'll have to see what happens, because this may be just a rally back to resistance and then another sharp decline. And I think probably the overall market will dictate and weigh heavily on what Goldman does. So Goldman needs help from the technology sector, from the oil sector, from the whole building sectors, and every one of them has problems. So if Goldman and the financials can't get it together by themselves, then they'll roll over and head to where the chart pattern, this big top, is telling me somewhere around 110 is the objective off of Goldman, and that hasn't changed. The only thing that's changed is this near-term sense that Goldman could get back up to this 148 from 138. We'll have to see what happens early next week. All right, so let's go over to Bank of America. What does that look like? Bank of America doesn't look all that fantastic either. It came down and managed to hold 1480, again 1480 in the May-June time frame. So there's your base, near-term base, 1470.80. Near-term resistance, well, you have the 50-day about to cross under the 200-day, unless it already has. Let's zoom in and see if the death cross is taking shape. Not quite. So you have the declining 50-day at 1647, and you have the flat 200-day at 1640. It's a pretty key area. So the prior highs 1610, then 1620 or 1640, 1650 is the next key area. Now, if Bank of America can get through this resistance plateau and manage to close above at 1480, well, then it's a whole new ball game, and I would suspect that the market is rallying fairly strongly too, and that whatever comes out of, or whatever is perceived to be coming out of Congress in terms of financial regulatory reform has been well discounted and adjusted to already by Bank of America investors. Not that there'll be a whole lot of difference, but let's go over to JP Morgan, which weathered the downturn better than its counterparts, but still, it's a pretty toppy chart. It's had a fairly substantial down move from nearly 48 to 36 and a half. And look, its 50-day is pointed down at a sharp angle at 40 and a half, and it already crossed the 200-day. That's not a pretty picture, but key resistance on a rally 40 and a half. It closed at 39.44, and so if you get a close above 40 and a half in JP Morgan, then maybe we have something to talk about on the upside. But for now, while it is poised, it looks like it's poised to move higher. Let's see if it can sustain higher prices rather than rolling over from this resistance plateau into new low ground, which would be very, very powerful selling pressure if JP Morgan took out this plateau at 36 and a half. And finally, let's do Citigroup. I don't know what the story is with the government selling stock at Citigroup, but Citigroup has some issues. It also has a very powerful declining 50-day MA at 410. It closed at 394, so let's see if it can break above 410. So in general, financial reform, looking at the big players in the banking sector, they've all sort of been immune to the last couple of weeks worth of news. Now that the news is behind it, the big bank sector, can it rally? And let's see if that happens. I think the jury's still out. A lot depends on the reaction tonight in the overall S&P and the foreign exchange markets as to whether or not the financials are so oversold and have so thoroughly discounted the impact of the financial regulatory reform that investors consider them relatively cheap now. I think the jury's still out. A couple of others that are getting a lot of press. The ICE, largely because a lot of derivative trading will have to be put on exchanges and taken out from within the drawers and the cubby holes of these banks. I must say that the ICE looks considerably better than any of the banks, and the additional trading volumes on these exchanges, while it's not a secret, has created a fairly friendly technical pattern over the last several months. And you have a big gap up here in ICE at 127, so it's at 117. So if the sector lifts, or if the perception is that the exchanges will continue to benefit from any financial regulation reform, then I can see ICE filling the gap at 127, testing the high around 131, 132. We'll have to see where it goes from there. I must also tell you that if it breaks 113 in low change, chances are there's a top on this, and it's whatever benefits it's reaped from regulatory reform over the last several months already in the price. One more is the Chicago Mercantile Exchange, which does not look nearly as healthy as the ICE. So I'd be very careful here. Yes, it's trading in a range, and yes, it looks better than the banks, but no, it's not a roaring bull situation. It needs to get above this 350 to really take off, and should it break last week's lows at 290, then I think you're going down to test this 273, 270 area, and that could put a major top in the Chicago Merc. Why? I don't know, but I would suspect that if the market can't rally in general, that the ICE and the CME charts will deteriorate, and they'll be breaking down just like all the other sectors have broken down. And then one more, let's just go over to the RKH, which is the regional bank holders. Now, the regional banks are perceived to be net winners in this process, but I don't see this chart as being all that fantastic.